But time now to welcome on board Sajjid Chinoy. He's of course joining us from JPMorgan. He's the India Chief Economist. Sajjid, hi. Good to be speaking with you. I understand that you've been part of certain meetings also with the Finance Minister, etc. and the Ministry. Talk to me about what are the big focus areas and what they are talking or concerned about right now.
Good morning. No, just stepping from the outside, I think there are two issues to look for in next week's budget. I think the first is to look closer at the fiscal math. And here the government enters next week's budget with significantly increased degrees of fiscal freedom. And what do I mean by that? If you compare next week's budget with one in February, for starters, I think the government delivered on fiscal consolidation last year. The budget deficit for last year was 5.8%. The actual number was 5.6%. And the target for this year was set at 5.1%. So there's less distance to cover this year, 0.5% of GDP. I think more importantly, there are more revenues that the government is working with. Gross taxes last year were stronger than was envisaged in the interim budget. They actually grew at a very healthy pace of 13.5%. So even if you make conservative assumptions for this year, the government is likely to have more tax revenues than was envisaged back in February. And then, of course, the RBI dividend that the government got was more than double of what had been budgeted back then. So essentially, the government has about 0.4 to 0.5% of GDP in fiscal space. And so the first question is going to be, how will that fiscal space be used? Will it be saved? Will it be spent? In the sense that will the deficit be lower or will the money be spent? And if it's going to be spent, where will it be spent? Will it be on the revenue side through tax cuts? Will it be more expenditure, revenue expenditure, or capital expenditure? So I think there's a whole set of questions on the fiscal math. And this is a good problem to have because there's this extra 0.5% of GDP that was not thought possible. Of course, the second question will be the broader economic statement, broader economic strategy in terms of growth and jobs and exports and manufacturing. So I think people looking at the budget will need to look at both these aspects. What is the fiscal math revealing? What's the broader economic strategy?
Sajjid, I was just going through your notes and you've talked about how it's important not to tighten the fiscal too quickly. Why is that?
I think there's a recognition here that we have already done meaningful fiscal consolidation at the center last year, where the deficit went from 6.4 to 5.6. B, there's a recognition here that we live in a very uncertain world. A lot of global uncertainty awaits us in the coming months and quarters. And also that India is still below the pre-pandemic path. So we still have some catching up to do. Growth has been very strong over the last 3 years. But there's still some slack in the economy because we're still below that pre-pandemic path. And so we want to be sure that, cyclical policy doesn't tighten too much. Monetary policy is going to be in the near term relatively constrained, both because of global factors and global headwinds, which could rise after the US November 5th election, as well as the fact that, food prices need to settle in and be convincingly lower before monetary policy acts. So given that there's still some catch up to do, given that monetary policy may be constrained, we clearly want to keep consolidating the fiscal. I think the government's been on a very responsible path over the last 3 years. So we want to keep going down that path, but make sure we don't do it excessively. I think 0.5% of GDP, given where we are economically, just seems just right for the moment.
Right. Sajjid, from an equity market perspective, and we were just chatting with Hiren there also about it, I think what the market wants is some sort of stimulus to the economy. The ailing end, of course, is rural, so some measures there. And the other, just how beautifully the government has managed to instill CapEx back into the system. They want CapEx to sustain. Do you think these two parameters would be delivered upon in this budget?
I think the CapEx thrust undoubtedly. If you just look at the interim budget, there was a lot of skepticism back in 2020 when the government said we want to undergo a huge CapEx infrastructure route because, there was a concern that does the government have the state capacity? Will fiscal space be created? And full credit to the government. We've seen central government CapEx double. It was 1.7% of GDP in 2019-20. It was 3.2% of GDP last year. And the interim budget has it at 3.4% of GDP this year. It's a growth rate of another 17% on the back of a 28% growth rate achieved last year. So I think that thrust is going to undoubtedly continue. The good news, of course, from an economy's perspective is last year the states also joined the party. State capex went up very meaningfully. So we now had both the center and the states continue. So I think there's no doubt that that continues. I guess the question is, there's another 0.5% of GDP in fiscal space. And, will that be spent on more consolidation? Will it be some tax cuts? Will it be even more capex, or will it be more revenue expenditure? It remains to be seen, but there's an opportunity here for the government to also boost revenue expenditure that is slated to grow more modestly. While capex is growing at 17%, that growth rate is closer to 3 to 4%. So there's a chance here to increase that expenditure as well. So in a sense, the government can have its cake and eat it too, because you could have a situation where the extra resources are used for even more consolidation, some tax relief, more revenue expenditure, more capital expenditure, and less borrowing. You could achieve all of these objectives because you have that 0.5%. Let me make one final point. I think we have to recognize that when the fiscal is tightening, it's a tightening of the belt. But importantly, this year, because a lot of the tightening is being achieved through the extra RBI dividend, and the RBI dividend, a lot of it came from the fact that these were interest earnings from what India holds in US treasuries. All of these were revaluation gains. So from a fiscal perspective, this is more like an asset sale. It is not a contractionary impact on the economy. It's not like cutting expenditures or raising taxes. So again, I think one source of relief is India could be in a situation where the budget reduces the deficit from 5.6 to 5.1, but there is no economic compression because a lot of this consolidation is happening through a non-contractually measure. So in a sense, we can see consolidation without compression.
Right, Sajjid. I just want to understand in terms of furthermore specific sectors, right? Capex thrust is going to continue. But if you specifically talk about the defense side or even the focus coming in on renewable energy, do you think anything specific we would see coming in for these sectors to push this furthermore?
So I wouldn't want to speculate on what exactly the government will pursue, but I think, over the last few years, we've clearly seen there have been some themes that the government has been working on capital expenditure, on renewables, on rural infrastructure, on trying to boost manufacturing and attract more multinational companies from China. And I would expect continuity on all those fronts. So I think this is a moment where, as I said, one has to look not just at where this year's allocations are being deployed in terms of spending, but what's the larger economic strategy here? I mean, one medium-term objective is to kind of boost tax to GDP even more. We've actually in a good situation where last year, if you look at combined tax to GDP, center plus state, it likely exceeded 18% of GDP for the first time ever in India's history. So we made meaningful progress on tax to GDP over the last 4 or 5 years. But we need to do more of that, because if you take a 10-year view of the economy, we clearly need more expenditure. We need even more spending on infrastructure. We will need resources on health and education, on skilling. We need some resources like other emerging markets on the energy transition, the green transition. So given that those expenditure obligations are only going to rise in time to come, and deficits need to go down, as we've discussed, the only way to square that circle is to ensure that tax to GDP goes up. We've seen encouraging progress the last few years. So I'd be looking at what other tax reform measures the budget announces.
Thank you so much for joining in with us this morning on ET Now, talking to us about what one should be watching out from the budget this time, and that's going to be on 23rd of July. Thank you so much, Sajjid.
If you like this video, then like, share and subscribe to ET Now.